All right, guys, we're going to talk a little bit about uh, financial terms here. This is a P&L or profit and loss statement. And as you see, we're looking at revenue stream one and revenue stream two. Just for example, let's assume this is like service and sales in a shop. So the sales would be the parts, service would be the labor. Um, so we could talk about income or revenue. These are kind of interchangeable terms. So as you see, the total income is going to be what I get for service and sales together. Now, if your shop was also doing car washes or gas, you'd add to this. But so that $9,000 number was our total income or revenue. Now, the next number that we're going to look at is profit. So when we talk about profit or gross profit, what we're looking at is what was the cost of the items and what was the income. So if I take income and I subtract the cost of the items, so the what I had to pay for the parts, um, that's going to give me my profit. Now, this was a sample P&L, um, so this is in millions, but it's worth noting. The next thing that I had to take into consideration are my expenses. Advertising. You are always going to have an advertising expense. That's your coupons. That's any flyers you put in the paper. If you took out an ad on Facebook online, that would be in your advertising and promotional budget. Um, Anything you're going to do to get the words out. Okay. Um, I use coupons here because that's probably your most common for a small independent shop. Now the next line is depreciation and amortization. What that means is two things: depreciation, wear and tear. I buy a new lift, it's worth less every year I use it. Amortization is when I spread the cost over a few years based off a loan. That cost is cost I pay out over time. Usually it's for a capital investment, large expenditures. There's insurance. That's business insurance as well as each and every one of your staff. Maintenance, upkeep of the shop, cleaning chemicals for the floor, just getting things inspected. Office supplies. How often do you think of that? And a lot of times, that and telecommunication, your internet, your cable, they're kind of combined. Um, but office supplies, you're going to spend a certain amount of money every month on paper, on staples, on pens, pencils, things like that. Your rent, your salaries are a huge amount. Travel. Travel might end up being a cost that you have if you have to send your techs or your writers out to get training. If you have to go and get training or if you have to conduct a deal, utilities, and then other expenses. So, what are some other expenses you might have? Petty cash, so you can buy your tech's lunch. Um, you might have a special promotional account, so to make sure that the techs still get paid out of. So there's a lot of things that might be another expense, but you're definitely going to have expenses that are over and above your normal just utilities, etc. Even things like uniforms. So you could keep adding expense lines on here. So then you're going to have a total expenses. So as of right now, you have all your expenses as well as your cost, you're taking that out of your total revenue. This is going to give you a number called EBITDA, EBITA. Earnings before interest and tax. Basically, your interest is going to be the amount of money you have to pay back to whoever lent you the capital money to get started. And then taxes are what you're going to have to pay to Uncle Sam, income tax or sales tax. So this number, this EBIT or EBITDA, is going to be a number that basically everything you made minus everything you had to pay out that was not interest or taxes. Usually that's considered the number that's the mark of financial health, is that EBIT number. So again, interest is going to be people or banks are going to lend you money to start your business. You have to pay them back for that service of lending you money. That's why they're investing in you. It's called a capital investment. People are putting a major amount of money in you. That's for you to open up your business. So until they're paid back, they're owed a share or interest. And obviously taxes are what you have to pay to Uncle Sam. And at the end of that, you will get your net earnings. Now, we talked about this in the last video. Net earnings are not what you as the owner put back in your pocket. It's what the shop earned. Now, depending on what type of business, I'm going to talk about that in the next video, that could determine if this is really something you can touch or something you can't. If it's a sole proprietorship and you want to take that money home, great, you can. But ultimately, that total earnings every month is what the shop made. So, and anything else other than a sole proprietorship, that money needs to stay with the shop. So at the top of the form here, I'm just writing in a couple of definitions you need to remember. The income or revenue is simply any money that came in. Now, when we got to figure out our profit, it's going to be income minus cost. Cost is not expense. Cost is literally what you paid for the parts. You can break that down by month. You can break it down by week. You could break it down by job if you wanted to. But cost is going to be what you paid for the parts. Okay. And then if you do income minus cost, that's going to give you profit. Now, something to keep in mind, if you were to go out and open up a business today, the fact is that number is going to be a negative number. You're going to be paying out, well, let me correct that. Your EBIT is probably going to be the negative number. You should be getting a profit no matter what. The question is going to be, is that profit enough to cover your expense? Usually in a new business, it's not. It's going to take a little while for that profit to cover the expense so that the EBIT works. Now, while I'm writing down a couple of these definitions just so you have them up there, I want you to take note of a couple things. This is a profit and loss statement. This is how you could track every month what money came in, what money went out, and did you turn a profit that you actually got to take home. This is valuable because you can then put it up and see the whole year. And how do you know if you're doing better or worse as a business? Well, you compare one month to the next. You can compare January to February, February to March. But once you're around for 2, 3 years, you're going to start comparing January this year to January last year, February this year to February last year. And the reason why is because depending on weather, times of the year, your location, different months are going to have different patterns. And that's what you want to compare. How are you doing in this pattern compared to last year? So that's a profit and loss statement.